When a lender searches your name to assess your credit application, they're not just opening one file. They're piecing together information from several different sources. And understanding those sources can completely change the way you prepare for your next credit application. Most people picture that what the lender sees is just one document with a credit score at the top. It's not. It's closer to a set of separate folders, each answering a different question. Who you are, what you've applied for, how you've repaid things, and in most cases, how you actually spend your money day to day. Understanding what's in each folder isn't about second-guessing yourself before you apply. It's just useful to know what's actually being looked at instead of guessing. If you're new here, welcome. I'm Novah. I've spent over 15 years inside the banking industry as a credit risk professional. On this channel, I talk about debt from a risk perspective. My intention is to replace fear with facts on consumer debt topics so we can all win with our debts. And if these are topics that interest you, consider subscribing and like each and every video that makes a difference to you. And don't forget to comment too. Everything I share in this channel is purely for general financial education and is not meant for personal financial advice. Later in this video, I'll show you why applying to your own bank can sometimes be a very different experience from applying to a lender you've never banked with, and why years of first-hand banking experience can matter during a credit assessment. Let's start with the basics. The starting point is simple: identity information, your full name, date of birth, current and previous addresses, and contact details. This isn't really about assessing you yet. It's about just confirming you are actually you and that the rest of the file being pulled belongs to the right person. It sounds basic, but it matters more than people expect. A mismatch here, a name spelled slightly differently, an old address can slow an application down before a lender has even looked at anything financial. So now we come to the biggest folder, and it's really several things bundled together. Most people think of just a score sitting on top of a page when they hear the word credit report. A credit report contains several pieces of information that together help a lender understand how you've managed credit over time. Let's walk through the main parts. The first part records your credit inquiries. Every formal application you've made for a credit card, a personal loan, a mortgage, or a car loan, these inquiries generally remain on your credit report for 5 years. And here's the part most people don't know. The inquiry itself doesn't tell another lender whether your application was approved or declined. It simply records that you applied. Now, if that application resulted in a new loan or a credit card being opened, that may later appear separately in another part of your credit report, which we'll talk about. But the inquiry itself never tells that story. So when a lender looks at your inquiries, they're not just counting applications. They're looking for patterns. How often have you applied? How recently? What type of credit were you looking for? And do those inquiries make sense alongside everything else on your credit report? And that's why multiple inquiries in a short period may prompt a lender to ask more questions. Not because inquiries automatically mean you are a higher risk, but because they want to understand what's driving them. And the next part is your credit accounts. This includes things like mortgages, credit cards, personal loans, and where reported buy now, pay later accounts. It shows when an account was opened, whether it's still open or has been closed, the credit limit for revolving facilities such as credit cards, and other information that helps a lender understand your existing commitments. Remember what I said a moment ago about inquiries. This is where the picture starts to come together. A lender might see that you applied for a personal loan a few weeks ago, and now they can also see that a new personal loan account has been opened. They're not looking at one piece of information in isolation. They are building a complete picture of yourself. And the next part is your repayment history. For eligible accounts, lenders can generally see around the last 24 months of repayment history. Each month simply records whether the required repayment was made on time. One late payment usually isn't the whole story. The overall pattern matters a lot. consistently paying on time tells a very different story from a repeated missed repayments over many months. Another section records more serious credit events. Things like payment defaults or serious credit infringements can remain on your credit report for a number of years and are among the most significant pieces of negative credit information a lender may consider. These are very different from simply making an inquiry or having a loan. There's one more part that many people don't know exists. If you formally entered into a financial hardship arrangement with your lender, a hardship indicator may appear on your credit report for a limited period. But here's the important part. It doesn't include the reason for your hardship. It doesn't include your personal circumstances. And by law, it doesn't affect your credit score. Only licensed credit providers can access this information. And in many situations, it demonstrates that you worked with your lender instead of simply missing repayments without communication. Remember, this may be different in different countries, but this is case in point for Australians. So that's a credit report, not one score, not one decision, several different pieces of information that lenders look at together to understand the bigger picture. So far, everything you've talked about comes from your credit report, but a credit report only tells part of the story. It tells a lender about your credit history. It doesn't necessarily show how you manage your everyday banking. And that's where things become more interesting. If you're applying to the bank you already use, they start with something another lender doesn't have. Years of first-hand experience. They've already seen how your accounts operate over time. Whether your salary is paid in regularly, whether direct debits frequently bounce, whether your account regularly goes into overdraft or are overdrawn, how consistently you manage your day-to-day banking. Security and fraud monitoring associated with your accounts are things your bank will see. And internal notes from previous dealings you've had with that bank. Exactly what is recorded varies between lenders, and those internal systems aren't shared with other banks. Now, if you're applying to a different lender, they don't automatically have that history. Instead, they'll often ask you to provide several months of bank statements as part of your application. They're looking at many of the same things: your income, your spending patterns, existing loan repayments, regular commitments, and how your accounts are being managed. So, whether a lender is looking at years of existing customer history or reviewing bank statements you've provided from another bank, they're ultimately trying to answer the same question. How do you actually manage your money day to day? And there's one more development that's changing how many lenders assess applications. Traditionally, if you are applying to a lender you didn't already bank with, they would usually ask you to provide PDF bank statements. Increasingly, many lenders now offer another option through open banking system. Instead of downloading and uploading statements yourself, you can choose to securely share your banking information electronically. And with your consent, the lender may be able to see verified information such as your income, your spending patterns, existing repayments, and other transaction data relevant to your application. This isn't a different credit report, and it isn't another credit score. It's simply another way of providing much of the same banking information that lenders have traditionally reviewed from your bank statements. Only is shared digitally, securely, and only with your permission. Whether a lender reviews bank statements you've uploaded or information you've chosen to share through open banking, the objective is the same: to better understand your financial position before making a lending decision. So, when a lender assesses an application, they're not relying on one score and they're not making a decision based on one inquiry. They're bringing together information from several different places: who you are, your credit history, how you've managed your existing credit, how you manage your everyday banking, and where you've agreed to it, information you've securely shared through open banking. Think of each one as a separate piece of puzzle. On its own, none of those pieces tells the whole story. But together, they help a lender build a more complete picture before making a lending decision. And that's why two people with similar credit score can still receive different outcomes. The score is only one part of the story. It's the underlying information that gives that score meaning. And there's one final point that's worth remembering. Every lender has its own credit policy and assessment criteria. That means two lenders can look at exactly the same information and still reach different lending decisions. So if one lender declines an application, it doesn't automatically mean every other lender will come to the same conclusion. So what can you actually do with all of these? One, request a free copy of your credit report from a credit reporting body from time to time. Is the best way to understand what a lender is likely to see. Two, just check your personal details. Something as simple as an incorrect address or misspelled name can sometimes slow an application or create unnecessary confusion. And three, review your credit inquiries. Make sure you recognize every application recorded on your file. An inquiry you don't recognize could be an early sign of identity fraud. And four, review your credit accounts. Make sure they are accurate, that closed accounts are recorded correctly where applicable, and that your payment history reflects what actually happened. And five, just remember that your everyday banking can also help tell your financial story. Lenders may look for patterns in how you manage your income, regular commitments, and day-to-day spending. And where possible, keeping your accounts well managed and addressing financial issues early can help demonstrate responsible money management behaviors. 6, if you find something that's incorrect, you have the right to ask for it to be corrected. You don't need to pay anyone to fix an error on your credit report. 7, if you've ever needed financial hardship assistance, don't avoid asking for help because you are worried about your credit score. A formal hardship arrangement doesn't affect your credit score by law, and it's generally far better than simply missing repayment without communicating with your lender. The key takeaway is this: lenders see several things and they don't make decisions based on one number or one document only. They're building a picture from several different pieces of information. So taking care of both your credit history and your everyday banking habits put you in the strongest position before you apply. So the next time someone tells you that a lender simply checks your credit score, you'll know that's only a small part of what's really happening. A lending decision is rarely built on the number. It's built on a much broader picture: your identity, your credit history, your existing commitments, your banking behavior, and where appropriate, information you've chosen to share. The more you understand that picture, the better you'll be prepared for your next application. Let me ask, what was the biggest myth this video busted for you about what lenders actually see? Let me know in the comments section below. If this video helped you better understand what lenders see, how they assess your applications, consider giving it a like and subscribing for more practical insights about debt. And until next week, remember, winning with debt is about making smarter decisions.